we are ready to make some additional types of adjusting entries. We left off on depreciation. So once again, the equipment we're going to depreciate at $480 a year or $40 per month. So we're now making the required adjustment at the end of the month of October by debiting the expense account, crediting the contra asset account known as accumulated depreciation. So notice that the accumulated account is going to increase by $40 each month over the next 12 months. Now on the balance sheet, the contra account, accumulated depreciation, is subtracted from the equipment account to determine what's known as the asset's book value. So book value is a term you may have heard of before when it comes to cars, etc. Book value represents the value of the asset, or it shows that portion of the asset's cost that's not yet been depreciated. So we're saying on paper, the equipment is worth this point $4,960. So accumulated depreciation, didn't mean to go that way, is a contra asset account subtracted from the equipment account on the balance sheet to determine what is the current book value for the equipment. Okay. Let's take a look at some unearned revenue adjustment. When you think about unearned revenue, it means that cash has been received before the revenue has been recorded. So if a tenant pays their rent 6 months in advance for the landlord, that's known as unearned revenue because they have received revenue before providing an actual service to that tenant. Or once again, if you bought an airline ticket in the month of May for travel to take place in August, for the airline industry, that would be known as unearned revenue. They received cash before providing with the actual service. Or maybe you pay for a magazine subscription for 2 years in advance. For the magazine company, that is known as unearned revenue. They receive cash before providing with the actual product. We have to make an adjusting entry at the end of the accounting period to show how much of the unearned revenue has been recognized by the end of the accounting period. So when you make the adjusting entry, we're going to decrease the liability account because unearned revenue is a liability, and you're going to credit a revenue account. Because what we're saying here is that once the unearned revenue has been earned, that portion now becomes revenue. All right, go to the example. We have the Sierra Corporation receive $12 on October 2nd. Remember that date. From Oronox for guide services for a multi-day trip expected to be completed by 12/31. And I got tongue-tied. I'm trying again. It says that the Sierra Corporation received $1,200 on October 2nd from Oronox for guide services for a multi-day trip expected to be completed by December 31st. Now, unearned service revenue was first credited on October 2nd. We would debit cash, and we would credit on October 2nd, unearned service revenue. Now, the question is, how much of that $1,200 has been earned by the end of October? It says that based on an evaluation, the company determined that $400 of the $1,200 has been earned in the month of October. Now, once it has been earned, it is no longer unearned revenue. It now becomes actual revenue. So on October 31st, we are going to make an adjusting entry. We're going to debit unearned service revenue, which is the liability account, and we're going to recognize service revenue in the amount of $400. So now, initially we had $1,200 in unearned service revenue, but now $400 that has been recognized. There's still a balance of $800 remaining in the unearned service revenue account. So you make an unearned revenue adjustment. You will always debit a liability for the amount that has been earned and credit a revenue account in order to increase and recognize your revenue. Don't forget, it includes one account from the balance sheet, one account from the income statement. When making the adjustment, you're going to either increase a revenue account or you're going to increase an expense account. Okay? I'm going to skip that and go into some other types of adjustments. I know you're ready for them. Got all those right. Good job. Okay. Let's look at adjustment entries for what's known as accruals. This means that revenue has been earned but not yet recorded, or an expense has incurred but not yet been recorded. So when you make an adjustment entry for an accrual, you're going to either increase a revenue account in order to recognize the revenue, or you're going to increase an expense account in order to recognize the actual expense. Okay, let's get right to it, shall we? All right. It says, in October, Sierra Corporation performed guide services for $200 that were not billed to clients before October 31st. So we performed the actual service. We have completed the performance obligation. However, we have not yet recognized nor recorded the revenue transaction. Because it was earned in October, the revenue, it has to be recognized and recorded in the month of October. So we're going to debit account receivable to show the amount of money owed to us for providing this service. And we're going to credit the revenue account known as service revenue. So when you have an accrued revenue adjustment, it means we're going to now recognize revenue that has been earned but was not recorded previously. Notice that because the revenue was earned in the month of October, it had to be recognized in the month of October as well. So here we have the journal entry in order to recognize and record the revenue that was earned in the month of October. Okay. Next, we have what we call an accrued expense. This is an expense that's already incurred. However, the expense has not yet been paid. So when you record an accrued expense adjustment, you're going to always debit an expense account in order to recognize and record the expense, and you're going to credit a liability account. The Sierra Corporation signed a 3-month notes payable in the amount of $5,000 on October the 1st. The note requires Sierra to pay interest at an annual interest rate of 12%. Okay? Now, we're saying here is that we must show the amount of interest that has accrued on this note by the end of the month of October. From 10/1 to 10/31 is a 1 month time period, right? So interest equals principal times rate times time. The principal amount is $5,000. The annual interest rate is 12%, but the time frame is 1 divided by 12. And that's because this 12%, that's the rate for an entire year. We're looking at the time frame for just the month of October. So it's 5,000 times 12% times 1 divided by 12, which means the accrued interest by the end of October would total $50. When making the adjusting entry, we're going to debit interest expense for $50 and credit interest payable for $50. The adjustment again shows the amount of interest that has accrued and that is owed by the end of the current accounting period. So once again, adjusting entry, you're going to either increase a revenue account or increase an expense account. The adjustment will consist of one account from the income statement, one account from the balance sheet. Sierra Corporation last paid salaries on October 26th. The next payment of salaries will not occur until November the 9th. The employees received total salaries of $2,000 for a 5-day work week or $400 per day. So notice that they were last paid on October 26th. We don't count the weekend. We owe them for Monday the 29th, the 30th, and the 31st. So we owe them for 3 days. If they're earning $2,000 for a 5-day work week, they're earning a total of $400 per day. 400 times 3 means the accrued salary total $1,200. When you make the adjustment, we would debit salary and wage expense for $1,200, credit salaries and wages payable for $1,200. The adjustment is to recognize the expense for the last 3 days of October, and because we still owe for it, recognize a payable account in the amount of $1,200. But once again, when making the adjusting entry, it either increases a revenue account or an expense account. It consists of one account from the income statement, one account from the balance sheet. Okay. So once we have made the required adjustments at the end of the accounting period, we're going to post those adjustments to the appropriate ledger account and then prepare what's known as an adjusted trial balance. Okay? So the adjusted trial balance shows each account balance after we have made the required adjustments at the end of the accounting period. We can then take those amounts to prepare our different types of financial statements. So here we see the adjusted trial balance. So once you made all the adjustments required for the accounting period, post those to the ledger accounts, we now have the adjusted trial balance that proves the equality of our debit and our credit imbalances. We're now ready to prepare our different types of financial statements. So stay tuned for the conclusion of our Chapter 4 lecture over the accrued basis of accounting.